I have a 4,000 target on gold. I think that's what we're probably going to see this year. My target on silver is 75. We could see that by the end of this year or certainly early next year.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for July 28th through August 4th, 2025, while supplies last. This week we feature 1 ounce Gold U.K. Britannia at just $59 over spot per ounce. 1/10 ounce Gold U.S. Eagles are just $47.99 over melt per coin. 1 ounce Silver South African Krugerrand are just $2.79 over spot per ounce. And 10th ounce Platinum U.K. Britannia are just $34 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend David Hunter, a contrarian market macro strategist with over 50 years on Wall Street. David, thank you so much for joining us today.
Yeah, hi Elijah, great to see you again.
Well, it's great to have you today, especially as we see big movements in the markets. We just had a meeting with the Fed, and it seems like people are concerned, again, that they're going to keep interest rates higher for longer here. Your take on the current market environment?
Yeah, I remain very bullish. I've raised targets in the last few months. I just raised in April, I raised my target to 8,000 on the S&P. In my most recent third quarter letter, I raised it again to 8,700. So I'm clearly by far the most bullish on the street. I think we're in a final leg of a 43-year secular bull market. We've talked about that before. And there'll be pullbacks along the way. I think here probably one soon, but this thing's got plenty of vertical move here ahead before we get to any problems. It could be very fast. I'm saying this last leg will go parabolic as we move towards the top. So parabolic means almost vertical, very steep. So you can cover a lot of ground in a short while. Those numbers seem crazy until you get into them and see how fast this thing can move. So everybody wants to pinpoint a time. I've been saying it could happen by fall. It doesn't have to, but that's still my view.
Now, last time we had you on, it seemed to be, it was actually kind of the start of a big pullback in the stock market. And a lot of people at that point, at the beginning of 2025, a lot of people were expecting that this was the big one. This was the crash. And we saw, a 20% downturn in a lot of the stock market indices. But we're back at all-time highs again. So it seems like your thesis that no, we still have this parabolic top to experience really has at least as of now really turned out to be correct.
Yeah, last April, obviously, when the tariffs were announced, they surprised the market in terms of how large they were and what Trump was in a negotiating pattern at that point. The market took it at face value, and so this is going to tank the economy. This is going to tank the markets, and most strategists on the street, most market analysts, turned bearish at that point. You started hearing the top is in. We aren't going back to the top. We're heading for 4,000. We're heading for 3,000. This is the bear market. And right under, at 4,900, 5,000 is when I raised my target from 7,500 to 8,000 on the S&P and raised the other indexes. I think I raised the NASDAQ from 23 to 25 at that time, or 25 to 27. But my thing was that everybody got so bearish so fast. Sentiment was actually back to levels in 2020, at the lows in 2020. What I saw there was that we rebuilt the wall of worry in a very short time, in a matter of a couple of weeks. And everybody was on the wrong side, and I got more bullish in my typical contrarian approach. So, I think we basically rebuilt the wall of worry. That wall of worry is the fuel for this final leg. And even up, 30% off the lows, you have a good deal of skepticism. People say, well, that's fine. We had another run, but they thought it was going to be a double top. It blew through that, which I said it probably would. And now they're looking and saying, gee, I don't know what to do. But they certainly aren't bullish. They are, some are kind of coming on board and going with the momentum a little bit, but there's still a lot holding back, saying, I want to pull back. Yes, maybe this thing has more to go, but I want to pull back. And that's, I've been saying we could see a pullback from, say, 6,500 on the S&P, but it's not given. I mean, those short-term scenarios may or may not work out. And, given the skepticism that's still in there, you saw the reaction yesterday to the Fed. This thing may just kind of keep rotating and feeding on itself, so that you could get a pullback back to the breakout, which was 6,100 area on the S&P, which would be 6 or 7%, maybe 5, 6, 7% pullback. That would cause a lot of people to get bearish again. I think even that little pullback, given how far we've come, could cause people to say, "Oh my God, we may have seen the highs," and that would just be, again, we'd be rebuilding that wall of worry, providing more fuel for the future, or we could just see that this thing is kind of in a rotating correction where different groups kind of correct. For instance, small caps, which started to go, have pulled back again here. So it remains to be seen. I don't have a crystal ball to tell you whether we'll get a pullback or whether we're kind of getting a sideways consolidation in here. But either way, I think the next few months is up. You could have a 2 or 3 week pullback, or you may not.
And as for precious metals, what is your take on that? Because obviously we've seen, we've talked about this together, this huge run up in gold and silver, and over the last couple of days we're seeing a significant sell-off pullback here. What is your current take on the state of the precious metal markets?
Yeah, I remain bullish on both gold and silver. Gold actually has done a nice job of consolidating since April. Basically a 3.5 month consolidation here at a high level, between 3,200 and 3,400, 3,500, I guess. And at the present time is more in the lower end of that consolidation. I don't think there's much downside here, if any. And I think basically you'll have another leg up here. I have a 4,000 target on gold. I can't remember exactly when I raised it, but since I talked to you last, I think I raised it from 3,400 to 4,000. And I think that's what we're probably going to see this year. So sometime between now and the end of the year, you should get up to that. Silver's a little more volatile, as we know, and scares people out oftentimes because of the volatility. It ran to $39 and looked like it. I think my next resistance level is the mid 40s, 44, 45, and not sure what it does there, whether it has a bigger pullback or kind of very short term stalls out and pushes through there. My target on silver is 75. We could see that by the end of this year or certainly early next year. And I don't view this sell-off as violent as it may seem to some, that we've come back from 39 down to 36 and change. A month ago, back in early June, silver was down in the 33.5 area, 33.25 area. So we're at the end of the month. It's the last day of the month. It's not unusual for these metals to fill in, and actually other markets too. So people have to be careful not to react to day-to-day stuff. If your low last month was 33.25 and you're at 36 and change now, and your your high last month was lower than the high today, you're still putting in higher lows, higher highs. And I think August will probably be another bullish month. So, silver looks great to me. I think the miners are finally, although they are again volatile and cause people to get nervous, they're in uptrends that will continue. And my targets for silver are SIL, which is large silver miners, to 75. I think that's on track. And SILJ to 35, which is a long way from here, but I think you could see that this year. So on gold, GDX, I raised my target, had been for a long time 65. I've raised that to 75. And my GDXJ, which is junior miners, remains at 100. It's a very clear target there that I think we can get there a little above that. So, I'm very constructive on both the metals and the miners.
And for those who are skeptical about the $75 silver, I think it's good to point out how fast silver can move in such a short period of time. Like I think it was 2011, it was about a 3-month period between $30 silver and almost $50 silver. So silver can move very fast, very quickly.
Yeah, it's not, I think we'll get to that old high at 49 change or wherever it was, 48 change, and push through that. And once we push through that, you'll see some pretty fast moves, I think, up to 75. So, it doesn't mean it's going to happen in the next 2 months, but I think in the next 6 months, you certainly could see it.
And how do geopolitical tensions, the trade wars, all of that play into your thesis? Because I know, as you mentioned, you're really looking at such a long-term time frame, a 40-plus year bull market and kind of the ending of that bull market there. So does, Trump being president, the tariffs, all of that, what the Fed is doing, does that really make a major impact on your main thesis of this melt up and then a huge crash?
It plays a role in the big picture. I mean, I think the pro-growth policies we're seeing out of this administration, deregulation, the bringing manufacturing back home, getting these deals where you're actually going to get foreign investment in this country that's controlled by us, that we can kind of decide where to put that investment. The immigration policy where you're controlling the border again, and tax policy, the big beautiful bill. All those things I think are going to feed into a long-term story, meaning post-bust, because I'm still calling for a global bust next year. But post-bust, I think those things are constructive to the economy, will be part of the story afterwards. In the short run, they create volatility. People react to various things in geopolitically as well as economically, and it can create some volatility there. But basically, I think the story, as I say, the bust, in my opinion, is baked in the cake. It's not the result of Trump's policies. It's the result of decades, and I mean many decades, of misappropriation of capital, cycles that got overheated and then got tightened down too far. And so what you've had is this ratcheting up, kind of a natural thing in the big cycle, in what I call a super cycle, where each cycle gets a little bit more extended and therefore takes more policy to crank it down. The excesses get greater. It takes more policy to crank those down. Then you go and overdo it on trying to get you out of that hole, and it becomes another one. And what you get is, I think somebody called it a buggy whip type of action, or a sine wave, I'm not sure, but where you get these steeper cycles. And so 2008-9 was our biggest post-depression, downturn and the crisis, financial crisis. I think we're going to see an even bigger one this time, where you go to these extremes on the market and then you come down. I'm calling for an 80% bear market from the peaks, Yeah, it doesn't have to be 80. It could be 70. It could be, something a little less than that. But I think 80 is a pretty good number. We haven't seen anything of that magnitude since the Great Depression, since the 29 crash. But we're in these excesses. Leverage is so far off the rails. We had tremendously high leverage in 2008-9, which gave us the Great Recession and the huge financial crisis back then. We have debt way beyond those levels now. Global debt's at 330 trillion. We have derivatives that are so much larger than, greater than what we saw back then. So derivatives are leverage on the markets. Debt is leverage on the system, on the economy. I think both of those things, when we turn down, will exacerbate the downturn and make it greater. So the fact that it's many, many degrees greater in leverage than 2009 simply means to me the likelihood is that we're going to see a bigger downturn, a bigger financial crisis than we had then. Different. I mean, we don't have the subprime issue that we had then. The banks in the U.S. aren't leveraged to the extent they were then, much less. I mean, we've really taken that leverage out of there. But around the world, this is a global bust, and around the world, there is just so much more leverage. And, banks that are fragile and vulnerable. So it may not start here. It may start elsewhere this time. But it will take in the whole globe, I think.
One wild card that's out there is obviously the development of AI, right? And I think in some sense there's a lot of positives to that. People are thinking, well, maybe we'll see a lot more economic growth. One aspect that I'm thinking of here is that a lot of the market trading is, based on algorithms, based on just computers trading with each other. So how does that impact your thesis here? And could it even be a deeper crash, right? If it's just computers, if it's just AI really running the show here?
Yeah, I can't say deeper than 80%. That's pretty, I don't have a crystal ball to be able to know whether it'll be something larger than that or something smaller than that. But 80 is kind of as a pretty severe, once in 90 year type of crash. So I'm not looking for AI to make it bigger than that, but I think AI will certainly contribute to that. And you're right. I mean, there's an awful lot of speculation and valuation being driven to the sky on some pretty rosy expectations. And a lot of those expectations obviously won't play out in the short run. AI is certainly here to stay, and AI will contribute to whatever the next cycle looks like, hopefully positively. But, my big thesis is, as I say, macro trumps all of that. And the macro is this, this huge leverage that takes us down sharply and leads to a massive response, both fiscally and monetarily, beyond anything we could ever have seen, we've ever seen before, and could ever imagine. I'm using, just as a seat of pants number, say 20 trillion out of the Fed in QE, new QE, that will take to pull us out of the tailspin. And proportionally similar from all the central banks. We did we were up to 9 trillion. We did from, 3.7 to 9 trillion in the 2020 response. And prior to that, in the 2008-9 response, we went from 875 billion to 3.7 trillion over a course of several years. So that to say that we're going to go from, we're basically 7 trillion now, I think, to go from there to 30 trillion, let's say, in response to this downturn, it shows you how much further beyond, and again, I could be wrong, but that's kind of what I see building up. And those kind of numbers, we use trillions, like we used to use billions, like we used to use millions, but those are huge numbers that we have never, ever seen before. They blow away anything in terms of proportionally anything we've ever seen. So what it means is that's the huge story. AI will be a sideshow to that, although AI will play a role next cycle. That macro, that massive and that massive money will be accompanied by maybe not as big as that, but a pretty massive fiscal response. That means debt's going to go even higher next cycle, as we come out of the bust. So you could be, we're at 330 now, we could be at 450 or 5 by the end of the decade. 500, from 330 to 500 trillion in debt. I mean, those are numbers we throw around, but they're mind-boggling. They're beyond anything that can really comprehend what that means. So it's hard to see where AI can compete with money of that magnitude or fiscal spending of that magnitude. But AI, I think, will be a productivity enhancer. So that's a good offset to what I think this massive money is going to lead to with a lag. It's not going to happen in 27. It's probably, you're going to see the bulk of the inflation late this decade, 28, 29, 30 and beyond. But I think what it ultimately leads to is inflation above 20%, maybe 25% in this country, hyperinflation around the world, and debt that has to be financed with interest rates that will follow the inflation. So if rates could get to zero, the 10-year could get to zero next year in a bust. If they start at zero, they could go to, if inflation goes 25%, the 10-year could go to something close to 20%, high teens to 20. How in the world do we service massive debt that we'll have as a result of that? That's why I say macro trumps everything else, even Trump's Trump, because his pro-growth policies are going to give us some of that boom, but that boom's going to come with huge commodity inflation. As we build factories and plants and equipment here, it's going to require a lot more commodity input than we have supply for. And that means you're going to have demand way outstripping supply and prices going through the roof. Just oil, which is a favorite of his, obviously. And I think we're in a bear cycle in oil. I think oil goes to $30 in the bust. But from there, I think oil can go to $500 by early next decade. That's what inflation means. That's in real terms, that's what you'll see. You'll see copper go from maybe, $1 or $2 in the bust to, who knows, $20, $30. I don't know where copper goes. Silver will go to 500, gold will go to 20,000. So that's what, in real terms, when I say 25% inflation by early next decade, in real terms, that's what it'll translate into commodities. And obviously, commodities flow through to consumer goods and everything else. So the consumer is going to be facing some tremendous headwind. Standard of living is going to be hit pretty hard, I think. Hopefully, I'm wrong on some of that in terms of the extremes. Hopefully, Trump has some policies that can, ameliorate some of that. Some of their plans to, try to reduce the deficits, and certainly growth will help the deficit. I don't buy the deficits that were being sold right now in terms of static analysis. I think Trump is right that you can grow some of your way out of those things. But once this thing explodes out of the other side of the bust, it's hard to see any policy being able to offset that.
In your take on the dollar index, then, I know it's kind of an unfair measurement rate because it's really just measuring the dollar against other currencies and they're all falling at the same time. But we have seen a bit of strength in the dollar here this month. It just now breaking back above 100, where it seemed like we were seeing quite a bit of weakness, 96 in the dollar just early this month. So your perspective on where the dollar will be heading in the coming months as we see this melt up materialize?
Yeah, just some perspective. 2 or 3 years ago, the dollar was 115, DXY, the index. It fell to 96 and change, I think, is where we bottomed out, week or two ago. And so we're getting counter trend trade here where it's moved, back up over 100. And it had gotten So that everybody who didn't see the falling dollar coming, I was calling, and I still am calling for 82 on the dollar index. And I've told I was crazy to even be looking for it to go down. People at 107, 108, 109, 6-9 months ago were saying it's going up. And it had a pretty sharp decline from there down to 96. So it's only natural that it's got to correct, because everybody's piled on the short side now, that it's going to have a short covering rally and counter trend move. I don't know how far it goes from here. I wouldn't expect a lot more. But, it can always surprise you and have a little more extension than you expect. And then I think it rolls back over, and we'll see 90 probably at some point in the next, 6 months, and then down from there. And so, my view is that the dollar is still in a downtrend. It's just in a counter trend rally at this point. As you say, the offset to that are all these other currencies. And I think you are seeing strength in the yen, although it corrected, started strong and then corrected. But rates are going up in Japan. There's no doubt about that. Whereas I think rates are coming down here. Rates are already come down elsewhere. So we have probably the biggest move in rates coming down over the balance of this year relative to rates coming down anywhere else. In other words, we'll move more down to the downside. That will help put pressure on the dollar. It's all relative. It's where you are today. It's not absolute rates. It's where you are today, where you're going. And I think rates here are going to come down pretty sharply.
Getting back to your view of what's going to happen to the money supply, right? How you're looking for 20,000 or 20 trillion, a 20 trillion increase in the Fed's balance sheet. You've also talked about in the past negative yields for U.S. Treasury bonds. So it seems like ever since 2008, we've almost been living in crazy world, right? Because the Fed has just been doing QE. It's been really doing measures that weren't available for it in the past, and using, expanding the Fed's balance sheet by multiples just within, months or years. And it seems like if we're going to continue, some people think it's crazy right now, but it seems like you're saying we're just getting started.
Yeah, it's not just getting started, but we are, we're in a super cycle. I define a super cycle as that period between the last depression and the next one. I think the depression was obviously the 1930s. The next one is the 2030s. Not 2030, but the 2030s, probably 2034 or 5, maybe 2033, but not before that, probably. So what happens in a super cycle is kind of what I was describing before. The cycles get steeper as you go. And now we're in certainly the last decade, maybe the last 7 or 8 years of a super cycle. And so things are getting far more volatile, far more violent. There's far more excesses in the system, and it requires far more in terms of policy response. And that's why, people take to task Fed chairman, the last name, Janet Yellen before her, Bernanke, and, what Bernanke did in response to the, Great Recession and the huge crisis, financial crisis, biggest financial crisis we had to date in history. He had to do some of what he did to get us out of it. Yes, in hindsight, probably stayed on the zero interest rate policy for too long, and led to the inflation in 2022, et cetera. Interestingly, all of that is what feeds into the bust, because you've now got a Fed who is fighting that last war. They don't, they got beat up pretty badly in 2022 for not foreseeing the inflation that we got. They thought it was transitory, and so they kept their policy pretty much intact and then had to scramble to catch up to it. Now, some of that was driven by oil, spiking during the invasion of Ukraine by Russia. We went from 85 to 130 on oil overnight. So some of that was, obviously investors and market traders are not patient people. So when something happens right away, they want to, play the blame game. They want to extrapolate things out. And so they decided it wasn't transitory, that, the Fed was wrong about that and they should have anticipated it. So now you've got Powell and the Fed who are fighting. They don't want to make that mistake again. They take that criticism to heart and they go, this time we gotta take seriously any uptick in inflation. We got to make sure we've wound out inflation before we go the other way. So while some people think he's being political, and I can't say he isn't to some extent, it certainly doesn't help when, whoever you are, if somebody calls you a loser, you're probably going to take a little bit of that personally as much as you try not to. So I'm sure there's some animosity there, and some I have no way of knowing whether there's any of that is in his policy. My gut is that most of what he's doing, because it's backed by most of Wall Street and it's backed by most of his committee, is based on this idea that we don't want inflation. We don't want to move too soon and then have to be right back here in a few months fighting inflation again and in a more difficult situation. So I think that's mostly what's driving him. I personally think they're late, as the Fed always is in each cycle, because of the leads and lags. They wait, they're looking at backward-looking data, and by definition, waiting for that to give them the signal. That means they're going to be late because of the lagged policy of 6 to 9 months at least. So that means you're almost guaranteed to be late by at least 6 or 8 or 10 months. And so I think they should be cutting here and beginning to rebuild the balance sheet, as crazy as it is at the levels we're at. However, I can't fault him yet, because basically so far they've been right to sit on their hands. So, but that is what I think could be part of the bust, is they're going to be even later than they would otherwise have been, because of what happened because of the criticism they got in 2022 and because of what happened in response to 2020 and, having to put so much money in. He's stated over and over, I'm not going back there. We are not going to repeat the mistakes of the past and go to zero interest rate policy. I chuckle because he doesn't realize, if I'm right, they will be back there, not by choice, but because there won't be a choice. They'll be pumping in money to save the system because it'll be in free fall. What will get money up to the levels I'm talking is a banking system around the world that's failing, that's in free fall, bigger than what we saw in 2008-9. And they can talk all they want right now about what they want policy to be and what they plan to do. When you're faced with a crisis that's right in front of you, that is bigger than anything the world has ever seen, you are not worried about what does our policy lead to down the road, inflation 3 years down the road. You're worried about the here and now. And they're going to start slow. And that's where I think this, fighting the last war comes in. They're going to start slow. Slow now, meaning they should be cutting, but they're not yet. Slow later, meaning, we now need to turn things around. We need to ease, but they're not going to ease fast enough. So they'll, and I'm talking about money more than rates. You'll see them say, okay, we'll do $1 trillion, but we're not going back to $5 trillion, and we're not doing what we did in 2020. And $1 trillion may be $4 trillion too little at that point in time. They wait a month or more, and things are still in free fall. So they say, we got to do more. We hate to do this, but we don't have a choice. What else? We don't have any other tool. So they do another 2 or 3 trillion or whatever. And that doesn't do it. It will take them several steps and several months to get to 20 trillion, to a level, or to any whatever level it turns out to be, that is the right size policy that finally stabilizes things and gets things turning the other way. So everybody thinks it's a matter of, when the Fed eases, you stop the cycle, you stop the downturn or stop the free fall. No, it's not only turning the policy around, it's right-sizing the policy. And because of what's happened in the last 15 years, 2008, 9, up through 2020, it means they're going to do the wrong thing at the wrong time. They're fighting the last war. They will get to it because they won't have a choice. And I'm not in the Austrian camp or the Peter Schiff camp that this is the big one. We go into a bigger depression. This is a bust. And it's a bust because they do have the printing press. It's a bust because we will have, I think, deflation in this bust, certainly low inflation and maybe deflation in this bust, which means they'll have the wherewithal to print money because the inflation in response to that money is at least a couple of years away, maybe 3 years away in terms of real inflation, big inflation. Because if you're coming out of deflation, your first year you might go to minor, low-level inflation. Second year might be mid-single digit or a little higher inflation. By the third year, you're in double-digit inflation and you have problems. But when you're in the midst of a free-falling financial system and an economy that's tanking, you're not going to be worrying about inflation. You're going to be fighting that war. But for a while, they'll not see that that's what they're facing.
Well, David, it really is always a pleasure to have you on and having you share your insights with our viewers. If our viewers are interested in learning more, they can go to your Twitter, Dave H. Contrarian. We'll put a link in the description of this video here. Did you want to share a bit about your newsletter that people can subscribe to?
Sure. I put out a quarterly macro letter. No advice in it. No trading in it. But I do I'm able to expand on what people see on Twitter. I'm able to expand on some of what I do in my interviews. So it's just an added piece in terms of my macro overview. And it's by subscription, meaning it comes with a cost. It's not for everybody, but I have a good number of subscribers that resubscribe each year. It's an annual subscription. If people are interested or think they might be interested, they can direct message me on Twitter, on X, and I'll provide details.
Fantastic. Well, David, thank you so much for your time today. You have a good day and God bless.
Thanks a lot to you too.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for July 28th through August 4th, 2025, while supplies last. This week we feature 1 ounce Gold U.K. Britannia at just $59 over spot per ounce. 1 10th-ounce Gold U.S. Eagles are just $47.99 over melt per coin. 1 ounce Silver South African Krugerrand are just $2.79 over spot per ounce. And 10th-ounce Platinum U.K. Britannia are just $34 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.